treatment of right shares in income tax. So friends, what do you mean by right shares? Right shares. A right given to the existing shareholder to purchase share at a lower price compared to the market price. I'll explain the concept of right shares. Listen, say for example, I'm an existing shareholder. I will get an offer from the company. Offer from the company to purchase shares, say at 700 rupees. The shares market value or the fair market value of the shares will be 1000 rupees. But I can purchase it for 700 rupees. This 700 is said to be right price. When a company issues further shares, the first preference shall be given to its existing shareholders, and that preference means the existing shareholders can buy that shares at a lower value compared to the market value, not compared to the face value. Companies Act 2013 never allows a company to issue shares at discount. So the right price will be always less than the market value, but it can never go below what? Face value. It will be always above face value. Now listen, so this right price and this offer is called as right entitlement. So I am an existing shareholder with a right entitlement. I have three options. Are you all listening? I have what? Three options. What are my three options? Either I can accept it, or I can reject it, or they can have another option. Most of the shareholders will go for that. Renounce. What is renounce? They will take that right entitlement and they will sell it to some other person. They will take that right entitlement and they will sell it to some other person. That is called as what? Renounce. Listen, when they are renouncing that right entitlement, say he have renounced that right entitlement for 100 rupees. He renounced that right entitlement for what? 100 rupees. Then what department will say is that right entitlement is also a capital asset. That offer letter from the company which is received by the existing shareholder, he is selling that right. He is giving up his right. Yes or no? That is also what? A transfer of capital assets. So you are supposed to compute capital gain on right entitlements transfer also. Now you tell me, what will be the full value consideration? When I am selling that right entitlement for 100 rupees, what will be my full value consideration? Are yaar, 100 rupees. When I am selling that right entitlement for 100 rupees, what will be my full value consideration? 100 rupees. What difference? No, 100 rupees is my full value consideration. Are yaar, I am selling that right entitlement to you for 100 rupees. What is my full value consideration? 100 rupees. Yes or no? I will ask all these kinds of questions. You should be very sharp here. Now, full value consideration will be 100 rupees. Now you tell me, what is my cost of acquisition? 0. I got this for free. I got this right entitlement because I am an existing shareholder. I haven't expended anything. Right entitlement, I got it for free, yes or no? So the cost of acquisition of right entitlement will be always nil. Are you with me? Now, the gains which I am getting, that 100 rupees will be always short-term capital gain. Why? Because according to the Companies Act, maximum period of right entitlement will be 90 days. You cannot hold a right entitlement more than 90 days. After 90 days, automatically it will get expired. So the gains that I am coming for a transfer of right entitlement will be always short-term capital gains. Are you with me? Now, say there is a person called Mr. K. Mr. K purchased this right entitlement from me. Mr. K purchased right entitlement from me, and Mr. K is known as right renouncee. The person who sold the right entitlement, existing shareholder, is known as the renouncer. The person who bought that right entitlement is called as right renouncee. Are you with me? Now listen, the right renouncee will pay 100 rupees to me. Then he have to pay another 700 rupees. That means the right price to acquire that shares from the company. So you have to buy 100 rupees. You have to buy the right entitlement by paying 100 rupees to me. and he have to go to the company, pledge that right entitlement and purchase shares at 700 rupees. So the total cost of shares of Mr. K while purchasing right shares from existing shareholders will be 800 rupees. It is a win-win for the renouncee as well as the renouncer, because the renouncer will get 100 rupees. Renouncee will get that shares for 800 rupees. If we try to purchase it from the open market, it will be 1000 rupees. Yes or no? So these are the events that happens in a right shares transactions. So listen, I'll repeat it again. If the right equity existing shareholder sell his right entitlement to a third party, the right entitlement transfer is a taxable transfer. Right entitlement is a capital asset. Full value consideration shall be the sales price. Now the cost of acquisition shall be 0. Why? Because you got that right entitlement for free. Now the renouncee, when he purchases right shares, he will have to pay that right price of 700 plus right entitlement cost of 100. So the total cost of one share for him shall be 800 according to our example. I hope you got my point, and the right shares treatment, the complete treatment, we have discussed it here. Okay friends, now let's solve a question. Please take question number 4. It's in page number 21. Alright friends, so let's read the question and solve the answer together. Mr. R holds 1000 shares in Star Minus Limited, an unlisted company acquired in year 2001-2002 at a cost of 75,000 rupees per share. Sorry, not 75,000 rupees per share, total 75,000. He has been offered right shares by the company in the month of August 2021 at 160 per share. So he got a right share in the ratio of 2 for every 5 share held. So first of all, let's understand how much number of shares that he got under that right offer. So his initial shares was 100 shares. For every 1000 shares. For every 5 share, he got 2 shares as right offer. So divided by 5 into 2, how many right share offer he got? 400 shares. So his right share offer was 400 shares. Now what they are saying is, out of that entire right offer, what he have done, he have accepted 50% of that offer and renounced the remaining 50. That's what the question says. Yes or no? So out of 400 shares, you can split that into 2. He accepted 50%, that means 200 shares, and renounced the rest 200 shares. So he accepted 200 and renounced 200. Now listen, so the renouncement, he say, renounces the balance right in favor of Mr. Q for 30 per share. That means right entitlement is sold for rupees 30 per share to Mr. Q. Mr. Q is the right renouncee. Now what happens is, then what is the next point? All the shares are sold by R for 300 per share in January 23, and Mr. Q sold all his shares at 280 per share. That too in December 2022. What are the capital gain taxable in the hands of Mr. R and Mr. Q? So they have given indexation numbers or index numbers as well. So what to do with this? First, let's compute the point of R. Mr. R. So how many set of capital assets he have? We can call it as original shares first. Original shares he have. Then he have right shares. Then he have right entitlement. These are the set of shares that Mr. R have, or set of capital asset Mr. R have. He sold original shares for how much? 300 per share. So 300 into 1000 original shares, that will be 3 lakh rupees. Now he sold the right shares. How many right shares he acquired? 200 right shares into 300 per share, not 3000, 300 per share. It will be 60,000. Now how many right entitlement he sold? 200 right entitlement he sold at a price of 30 rupees. That will be 6,000 full value consideration. Now tell me, is there any expenditure, direct expenditure on transfer? Nothing. So I'm straight away going to cost of acquisition. Since there is no direct expenses on transfer, straight away we can find out the cost of acquisition. And how much is the cost of acquisition for original share? He bought it for 75,000 rupees. In the year 2001, 2002, so you can index it. Yes or no? So 75,000 into 331 divided by 100. Tell me how much is the indexed cost of acquisition? 248, 250. Now, right shares, can he index? Let's see. He got the right offer in the month of August 21. He sold that particular share in January 23. August 21, January 23. How many months you have? Less than 2 years. This is being a star minus limited and unlisted company. The period of holding should be 24 months. If it is listed, 12 months. Are you all with me? I hope you remember the period of holding criteria for unlisted shares and listed shares, etc. So, what we can do is, it is a short-term capital asset. So, we cannot index it. So, 200 into, what was the right price? 160 per share. How much will be the cost of acquisition of right shares? 32,000. Now, how about right entitlement? Nil. Because as I've told you, for right entitlement, you don't have to incur any cost of acquisition. It's absolutely free. So, let's compute the capital gains now. So, in the first case, how much will be the long-term capital gain? 51,750. Second case, 28,000. Third case, 6,000. These two are short-term capital gains. So, total capital gain by adding long and short everything together. How much will be the total capital gain? 85,750 will be the total gain for Mr. R. Now let's compute the effect of Mr. Q. So Mr. Q, his name is Mr. Q, right? So Mr. Q sold 200 shares into 280 rupees. So how much is the full value consideration? 56,000. There is no direct expenses, so I'm straight away going to cost of acquisition. Cost of acquisition for him, he purchased right shares by paying 160, plus he purchased right entitlement for 30 into 200 shares. So how much will be his cost of acquisition? 38,000. Now you tell me how much will be his capital gains? 18,000. That will be his capital gains, and that is the final answer to the question. I hope it is clear.
To purchase recorded lectures and textbooks, visit our website www.cajosekurian.com.